Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial mysteries, and today we've got a doozy from the Federal Home Loan Bank of Pittsburgh. Get ready to dive into some serious money matters, because sometimes the most interesting stories are hidden in plain sight, or in this case, plain old government filings. Before we dive in, if you find value in cutting through the corporate jargon and getting direct insights, do us a favor and hit that subscribe button. And for those of you who love a good financial chat and want to connect with fellow enthusiasts, we've got a community Discord channel linked down in the description. Come join the conversation. Alright, so what we're looking at here is a Form 8, which is basically a heads up about big important stuff happening with a company that isn't usually covered in their regular quarterly or annual reports. Think of it as a special announcement. This particular report is for the Federal Home Loan Bank of Pittsburgh, or FHBank as well call them, and the earliest event reported happened on the 1st of December 2025. Now, FHLBanks are a bit unique. They are not your typical banks, they are government-sponsored enterprises. Their main job is to support mortgage lending and community investment across the country. They do this by borrowing money in the capital markets and then lending it out to local lenders like banks and credit unions. The main reason for this filing is to let us know about a new financial obligation. For FHLBank Pittsburgh, this means they are creating a new debt, and since they are part of the Federal Home Loan Bank system, any debt they take on is actually a joint and several obligation of all 11 Federal Home Loan Banks. That means if one bank can't pay, the others have to chip in. It's like a big financial safety net for these consolidated obligations. These aren't loans from the government directly. Instead, the FHL banks raise money by selling what are called consolidated obligations. Think of these as bonds and notes that are backed by the financial strength of all the FHL banks combined. But importantly, not by taxpayers or the US government, the Federal Housing Finance Agency, or FHFA, is the one keeping an eye on things, making sure these obligations are managed properly. The really interesting part of this filing is called Schedule A. This schedule is where they detail the specific debt issuances. It lists bonds and discount notes that are being issued where FHL Bank Pittsburgh is on the hook to pay them back. They exclude the short-term stuff, less than a year, that they issue all the time as part of their normal day operations. They also include any debt where they've taken over responsibility from another FHL bank. Now, it's important to understand what is not on this schedule. They explicitly state that Schedule A doesn't cover things like interest rate swaps or other complex financial tools they might use to manage their risks. This is pretty standard, but it means the numbers on Schedule A are just a snapshot of the raw debt, not the whole picture of their financial hedging strategies. They also make it clear that you can't just look at Schedule A to figure out their total debt, because they leave out short-term debt and don't tell you if the new money is just replacing old debt. It's not a running total of their overall debt. For that, you'd need to look at their regular financial reports. And one more crucial point about Schedule A, the debt amounts shown are the par value, which is the face amount of the debt. This can be different from what you see in their main financial statements because those statements account for things like original issue discounts or premiums. So the numbers here are straightforward face values, not the nuanced accounting figures. The actual details of the debt issuance are in Exhibit 99.1, which is Schedule A. Although the specific numbers for the debt issuances aren't directly in the text provided, the structure of this filing tells us that FHL Bank Pittsburgh is actively managing its funding by issuing new debt instruments to finance its operations and support its lending activities. Let's talk about what this means. These issuances are the lifeblood of FHL banks. They need to continuously raise capital to make sure they have enough money to lend to member institutions. When they issue new debt, it's usually to refinance older debt that's maturing or to fund new lending initiatives. From a Warren Buffett perspective, we're looking for entities that can consistently generate returns and manage their liabilities prudently. FHL banks operate in a somewhat regulated and specific niche, focused on providing liquidity to the housing market. Their success hinges on their ability to access capital markets at favorable rates and manage the risk associated with their assets and liabilities. The fact that they are issuing new consolidated obligations is not inherently good or bad. It's a normal part of their business. What we'd want to see, if we had the full Schedule A, are the amounts, interest rates, and maturity dates of these new debts. Generally, if they can issue debt at lower rates than on average they earn on their assets, that is a positive. If rates are rising and they are issuing significant amounts of new debt, it could signal increasing borrowing costs and potentially tighter margins. The mention of the joint and several liability is a key point for the stability of the entire FHL bank system. It spreads risk across all 11 banks. This diversification is a strength, as it prevents a localized issue at one bank from causing a systemic problem. However, it also means that all banks are interconnected and a severe downturn in one could impact the others. Given that this is just an 8K and not a full financial report, we don't have the detailed income statement or balance sheet figures to do a deep dive into their performance. But this filing tells us that FHLBank Pittsburgh is actively engaged in the capital markets to fulfill its mission. Looking at this filing, what stands out is the structured approach to disclosing new financial obligations. They are being transparent about the nature of the debt and how it fits into the broader FHLBank system. The emphasis on excluding certain derivative instruments and the explanation of par value versus accounting value are important nuances for anyone trying to understand their financial picture. So, taking a step back, FHBank, as part of a larger system, is a critical player in the housing finance ecosystem. Their ability to raise funds through consolidated obligations is paramount. This filing simply confirms that they are continuing to manage their funding needs through these established channels. The real story would be in the details of the debt itself: how much, at what cost, and for how long. Without that specific data from Schedule A, it is hard to draw definitive conclusions about their current financial strategy or performance. Alright, that is our decoder on this FHLBank Pittsburgh filing. It's a technical one, but understanding these foundational pieces of financing is crucial. What are your thoughts on how these government-sponsored enterprises operate? Do you see any particular risks or opportunities based on this type of disclosure? Let us know in the comments below. If you found this breakdown helpful, please give us a thumbs up and subscribe if you haven't already for more corporate financial insights. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next Decode.